Good afternoon, everyone. Welcome to the class on investment management. So we have done till now the all the numericals of bond arithmetic. So we have completed all the numericals what possibly can come from the VTU with respect to the bond calculation. So whenever we talk about a debt instrument, so in the case of debt instrument, whenever we talk about debt instrument, so what is a debt instrument? Debt instrument is basically it is a form of raising money. If I speak little bit theory about the debt instrument, what is basically a debt instrument? Instrument is all about raising money from the market where the ownership is not transferred. Okay, so there's difference between debt and equity. In the case of equity, the ownership is being transferred, while in the case of debt, the ownership is not being transferred. So whenever we talk about debt instrument, so the debt instrument is all about borrowing. So it's all about borrowing for a fixed duration of time. It is all about borrowing for a fixed duration of time, for a fixed duration of a time. Okay, so it's all about borrowing for a fixed duration of time. So here, whenever we talk about debt instrument, so in the case of debt instrument, there's a person who's looking for the fund. So that person who's looking for the fund is called as issuer or creditor. So so the issuer or creditor. So the person who's looking for the fund. So what this person will do? So he's looking for the fund. So what he'll do? He'll borrow the fund from the market. So the debt instrument is all about borrowing for the fixed duration of time. Okay. So whenever we talk about debt instrument here, the ownership is not transferred. So whenever we talk about debt instrument here, the ownership is not transferred. In the case of debt instrument, the ownership is not transferred. So this is debt instrument where the ownership is not transferred. So in the case of debt instrument, debt instruments are always issued for a definite time period. Okay, after that they get mature. There are some kind of debt instruments which are issued for infinite time period. Those are called perpetual debt instruments. Okay, so in case if a debt instrument is issued for infinite period of time, so in case if a debt instrument, in case if a debt instrument is issued, in case if a debt instrument is issued infinite time period for an infinite time period for an infinite time period. Okay, so it is called as perpetual bond. Okay, so it is called as perpetual. There's a word called perpetuity. Perpetuity means infinity. Annuity means definite time period. It is called perpetual debt instrument. Okay, so such kind of they are called as perpetual bond. Okay, so you'll hear this word perpetual bond. Such kind of instruments are called as perpetual bond, which is issued for the infinite time period. So you can type in Google also about perpetuity. So here, if I type perpetual bond, you get information about perpetual bond. So what is perpetual bond? It is also known as console bond or prep. Is a fixed instrument with no maturity date. So this maturity date involved here because they're issued for infinite time period. This type of bond is often considered a type of equity. Why we call them as a type of equity? Because you remember, no, in ordinary share, whenever a company issue a ordinary share, they issue it for infinite time period. Like the same way, so perpetual bond is also called as equity only. But the only difference here with the term of equity would be in the case of equity, the payment of dividend is not the compulsion for the company, but here the payment of interest would be the compulsion for the company. So that difference you can create. Okay, so one major drawback to these type of bond is that they are not redeemable. They are not redeemable means redeemable. Redeemable means something which get mature in the future. Non-redeemable means which never get mature in the future. Okay, so whenever we talk about preference shares and all. Preference share, it is a redeemable equity instrument, while the equity share, it is an irredeemable equity instrument. However, the major benefit of them is that they pay a steady stream of interest payment forever. So I hope you can understand. So here, the coupon or the interest, whatever is the compulsion for the company, they will pay you after every regular interval of time. Okay, and there's no maturity for them. Perpetual bond. Okay, so this is what perpetual bond is all about. So perpetual bond exists within a small niche of bond market. This is mainly due to the fact that there are few entities that are safe enough for the investor to invest in a bond where the principal will never be repaid. So I hope you got the logic. So whenever you talk about debt instrument, in the case of debt instrument, there's a money what the issuer take from the investor, that is called as the price of the debt instrument. And then after every regular interval of time, the issuer will give their investor a fixed amount of amount which is called as coupon. Okay, which is called as coupon, and this coupon is calculated on the face value. And then on the maturity, the issuer gives to the investor the face value or the principal. But in the case of perpetual bond, since they never get mature, so you never get the face value. So this is what they have mentioned in this line. Some of the notable perpetual bond in existence are those that were issued by the British Treasury for the World War One and South Sea bubble of 1720. Some in US believe that the federal government should issue a perpetual bond, which may help it to avoid the refinancing costs associated with bond issue that they have maturity dates. So this line is saying that I hope you must be aware about that the US is the largest issuer of the debt instrument around the world. So around all the countries, the most secured country for the investment is USA only, because the USA is the most powerful country in the world, and the dollar is the most liquid currency in the world. So automatically the demand of the treasury instruments what is being issued by the US Treasury Department, that always have a value in the market. So like the India, we have Reserve Bank of India. Like the same way in USA, we have something called Federal Reserve. So Federal Reserve is like RBI of our country, and the debt instrument what is being issued by Federal Reserve has a maximum demand in the international debt market. So that way you can understand. And lot of investors, mutual funds, hedge funds, okay, lot of provident fund companies, all around the world, they prefer to invest in the US Treasury instruments. So that is what is being mentioned, that US Treasury instruments should issue perpetual bonds, because so that way, what if they issue perpetual bond, then there's no headache of refinancing cost, which they need to incur whenever the one instrument get mature and the another instrument get issues in the market. So I hope you got an example or you get an understanding about what is perpetual bond. The formula for the present value of the perpetual bond, that is nothing but coupon divided by rate of interest. That would be the formula for determining the price of the perpetual bond. That is coupon divided by the rate of interest. So here example is also given. For example, if a perpetual bond pays $10,000 per year in perpetuity, so $10,000 per year is nothing but it is the coupon what they're paying, and the discount rate is 4%. So what is the present value? So what is the price? So you can find the price by dividing 10,000 by 4%. So that will come around 2,50,000. So I hope you got the logic about what the perpetual bonds are all about. So normally whenever a debt instrument are issued, they are issued for a definite time period, but exceptions are perpetual bonds. Okay, so depending upon whenever we talk about the debt instrument, depending upon the duration of the debt instrument, depending upon whenever we talk about duration, fixed duration of time. So depending upon the duration of the debt instrument, they can be either called as short-term debt instrument. They can be either called as short-term debt instrument, or we can call them as a long-term debt instrument. We can either call them as a long-term debt instrument. We can either call them as a long-term debt instrument. Short-term debt instruments are also called as money market instruments. Short-term debt instruments are also called as money market instruments. Okay, so money market instruments, whenever we talk about a money market instruments in India, so in India, the body which regulate the money market instrument is FIMDA, Fixed Income Money Market and Derivative Association. So the body which regulate the money market in our country, that is called as FIMDA. And in money market is basically it is a cartel of all the mutual funds companies, the companies, the banking and other financial institutions in around in our country, NBFC, it is a cartels of NBFC banks and other financial institutions in our country. So where they borrow and lend money among themselves. Corporates are allowed to borrow money from the money market, but they are not allowed to lend money in the money market. Example for the money market, example for the money market can be commercial paper. So when you talk about commercial paper or certificate of deposit, or we talk about treasury bill. So when we talk about treasury bill, or when we talk about call notice money, so these all are the example of money market instruments. The money market, whenever you get time, read about the money market instruments. So get in more information about money market instruments in India. So whenever I talk about money market instruments in India, so you can see this. So the money market instruments. So what are money market? It is a market for securities with short-term maturities up to 1 year. Bank, non-banking financial companies, and acceptable houses make up to the money market is facilitate the transaction for short-term fund and maintain the appropriate liquidity in the market. So that is basically is all about money market. So what are money market instruments? So you can read about what are money market instrument features. So in mutual funds also, when you do investment on mutual fund, so you can also, if you look for short-term liquid fund, so the where the your money will be invested, your money will be invested in money market mutual funds. Money market instruments, they have maturity less than 1 year, so we call them as a money market instrument. So you can read about them. So what are the purpose of money market? So it's basically it's the cartels of different financial institutions in and around our country where they borrow and lend money among themselves in the form of call or notice money if they want, like for a fortnight basis, or for a 1 day basis. If they borrow and lend money, so they do in the form of call and notice money for working capital management. If they need money, then they raise money in the form of commercial paper. Corporate, if they need money for their working capital problem, then they raise money in the form of commercial paper. While banking institutions, for their working capital management, they raise money through certificate of deposit. Like similarly, government of India, when government of India need short-term liquidity, then they request RBI to issue short-term debt instruments in the form of treasury bills. So treasury bills are either 91-day treasury bill or 181-day treasury bill or 365 days treasury bill. Okay, so that is about the treasury instruments. So gradually, when we see money market, so in the money market, the banks used to borrow and lend money among themselves. So the RBI keep an eye of the transactions in the money market, and what they do normally, the whenever the borrowing and lending happens, then it will happen at an interest rate. So the interest rate can be fixed or the interest rate can be floating. So in case if your interest rate is floating, then they use MIBOR as the benchmark rate. Then they use MIBOR as a benchmark rate. MIBOR, when we talk about MIBOR, MIBOR basically means Mumbai. When we talk about MIBOR, basically means Mumbai interbank offer rate. So whenever we use the word called MIBOR, MIBOR basically means Mumbai Interbank Offer Rate. So what happens every day, RBI, every day in the morning, what RBI basically do, RBI look at the rate at which the banks borrows and lend among themselves one day back. So in one day back, at what rate the banks borrowed and lend money among themselves, and then the RBI determine the weightage average of that, and that is called as MIBOR. So for the today borrowing and lending, MIBOR would be considered as a benchmark rate. In the international market, LIBOR is considered as a benchmark rate. LIBOR stands for London Interbank Offer Rate. So whenever one international bank, like suppose if SBI go to Tokyo, or maybe SBI go to Singapore, and they're raising some money from some Singapore exchange. So at what rate they will do? They will do in the form of LIBOR plus certain basis point. Normally whenever the transactions happens in the market, whenever you talk about debt instrument, so whenever the two bodies get into the debt instrument obligation, so then one body can pay fixed interest rate, or they can pay floating interest rate. So the benchmark what they'll use LIBOR or MIBOR, or any other benchmark rate. So normally there one term will come, that is called as basis point. Remember what is basis point. So what is basis point? Very easy. 1% is equal to 100 basis point. Understand that. So if I say 0.25%, 0.25% is nothing but it is 25 basis point. Understand this part. Okay, so if repo rate, if repo rate from 6%, if repo rate from 6% became became 6.25%. So it increased by, it means it increased by, it means it increased by, it means it increased by 25 basis point. It means it increased by 25 basis point. Okay, so the in the floating market, whenever we talk about transaction, we do in the term of basis, LIBOR plus minus basis point, depend upon the credit rating of the different institutions. Like suppose if there are two institutions, if they do transaction and both have the same credit rating, so definitely they will do at the MIBOR only. But if there's a weaker institution borrows money from the other institutions, which is stronger institution, definitely then the stronger institutions will give money to the weaker institutions at the higher rate, because you can understand for the weaker institution the probability of default is high because the credit rating is less. So if the stronger institutions gives money to the weaker institution, then the stronger institution is taking a risk. So to compensate the risk, the weaker institutions has to give more interest rate to the weaker, stronger institution. So that is the logic what we follow, because whenever we talk about debt instrument, in the case of debt instrument, one person borrows money from the other person with an obligation to pay back the money in the future. Now the question arises, what is the guarantee that the other person will pay back the money? So to ensure that guarantee, there's always a risk involved in the case of debt instrument, that is called as credit risk. There's always a risk which is involved in the debt instrument, that is called as credit risk. Credit risk is very big risk when you talk about banking institutions. Yeah, I hope you have heard about NPA, non-performing assets. So there are a lot of, if you see the history of scams in our Indian financial institutions, not about Indian financial institution, all around the world, you can understand so many scams are happening around the world. So many people are defaulting on the loans, on the borrowing what they have taken from the bank, and ultimately the bank has to bear the burden of that, because you have to understand bank don't have any money by themselves. They take money from one end and give money to the other end. So all the money what you deposit into the bank, that is like a liability for the bank, and the same money the bank try to convert into asset by disposing them in the form of loans in the market. And from these loans the bank earns interest. Okay, and that interest what they earn, they make sure that the interest what they're earning from these loans, that should be more than the interest what they need to pay on their deposits, and the difference of that is the profit for the bank. But imagine the people who have taken loan for the bank, imagine if they're not able to pay back that loan, then what will happen to the banking institutions? Then gradually the NPA of the bank will keep on increasing. Okay, to ensure that the bank does not face this kind of problem. So there are a lot of in the past, the banks, the banking institutions had met many times to discuss the kind of risk a banking institution can face. You can understand, if a company get default, it is a different thing, but if a bank get bankrupt, it will affect everyone around the system. So we have to make sure that the banking institution should not get defaulted. That's why Reserve Bank of India put lot of cap about the way the bank should work. Okay, so when we have heard of CRR, cash reserve ratio, SLR, statutory liquidity ratio, then capital adequacy ratio. Lot of norms has been put by Reserve Bank of India to make sure the banks in our country should not get default. Time, then at the same time around the world, the financial institutions around the world have discussed many times the reason why institution can default. So what they have done, so they have came up with something called, Basel norms. So you should know about Basel norms. So as a student of finance, you should know about Basel norm. Right now we are in Basel 3, so you should know about Basel norms. So basically, when you talk about Basel, Basel is a place in Switzerland where after every like definite time of period, the banking institutions used to meet, and they used to the reason why the bank can default, what kind of risk the banking institutions are facing. And then they came up with Basel norms. So this is very important. Everyone, finance student, they should know about Basel norms. So you should have an idea about Basel norm. Right now, after Lehman Brothers bankruptcy in 2008, now the Basel 3 is being implemented, and around banking institution around the world has to change their regulatory pattern as per the Basel 3 condition. So first time when the banking institutions met around 1970s in a place called Switzerland, and they were discussing the reason why the banks can get default. So that time there only one risk what they have thought about, that was credit risk. To avoid the possibility of credit risk, then they came up with something called capital adequacy ratio. Around the world, the banking institution around the world maintain 8% capital adequacy ratio, but as per the RBI norms, banks in our country follow 9% capital adequacy ratio. Okay, so but again the bank got defaulted. So then they came up with Basel 2. So Basel 2, in the case of Basel 2, they came up with more risk what a banking institution can face. Those risks can be liquidity risk, credit risk, market risk, operational risk. Okay. Then after Lehman Brothers, then they met and they discussed again what can be the reason why the Lehman Brothers got bankrupt. Lehman Brothers, which was the world fifth largest investment banking company in the world, which was around 168-year-old bank. Why Lehman Brothers can get bankrupt? So then they understood the importance of liquidity, and now the banking institutions have to follow a lot of norms based on liquidity also. So whenever you get time, read about Basel norms. What are Basel norms? What is being discussed? What all happened? You can see this Basel norm. So Basel is a city in Switzerland. So it is a headquarter of Bureau of International Settlements, which fosters the cooperation among the central banks with the common goal of financial stability and common standard of banking regulation. Okay, the Basel Committee on Banking Supervision is housed in BIS office in Basel, Switzerland. What are these norms? So Basel one, it came in 1988. Okay, so it focused entirely on the credit risk, which I told you. India adopted the Basel I guideline in 1999. Basel II came up with in 2004. So Basel II guideline was published by BCBS. This is important. This is very important. So the guideline were based on meter, which the committee call its pillar. So this question was asked to me when I went to the interview in TCS. So I worked in TCS in past. So in TCS, to me, they have asked this question: what were the three pillars of Basel II? So the three pillars of Basel II was capital adequacy requirement, then supervisory review process, and the market discipline. So these are the three pillars of Basel II. So my time was around when I went for it was 2008 or 9. So now we are into Basel 3. So if you will go for interview in some financial institution, then they will ask you basically about Basel 3. So now if you will go for interview, so these the Basel 2, these were the pillars. Now Basel 3 guideline was came up in 2010. Okay, these guidelines were introduced in response to the financial crisis of 2008. I hope you must be aware about 2008 financial crisis, which started after the bankruptcy of Lehman Brothers. If you're not aware about 2008 financial crisis, then probably you can type in YouTube or Google about 2008 subprime crisis or extra leverage crisis of 2008 and try to get more information about that part. So a need was felt to further strengthen the system as the bank in the developed economies were undercapitalized, over leveraged, and had a greater reliance on the short term funding. So the basically the reason for the 2008 crisis was extra leverage. So the leveraging, I hope you have heard of this term called leveraging. So the leveraging, we have studied the chapter called financial and operating leverage, where we studied two kinds of leverage. Operating leverage, it is a proportion of variable cost by fixed cost, and financial leverage, it is about the proportion of equity to debt. Leverage, financial leverage will come in picture when you have more debt in your capital structure than the equity. Then the financial leverage come in picture. Okay, so around the world, the banking institutions, they get involved in too much debt issues, and more complicated instruments were issued in the form of derivatives. So derivatives is not there in your course. Probably maybe next semester you will have derivatives. So altogether, the financial industry around us is being complicated or magnified by the use of derivative instruments. So if you get a time, read about derivative instrument, or if you go to my YouTube channel and inside finance, you will get a lot of videos on derivatives. You can watch those videos to understand derivatives in much more better way. So Basel III guidelines were aimed to promote a more resilient banking system by focusing on four vital banking parameters. So either they talked about capital or leverage or funding or liquidity. Okay, so the capital adequacy ratio to be maintained at 12.9%, the minimum tier 1 capital ratio and the minimum tier 2 capital ratio to maintain at 10.5% and 2% of risk weighted assets. So before, as per the Basel norms, assets were identified. So all assets cannot be of same risk class. So then the new term came in picture as per the Basel norm, that was called risk weighted assets. Okay, depending upon the risk of an asset, the risk weighted asset is being determined. So all this you can read about them, the leverage ratio, funding and liquidity ratio. So this new types of ratios were introduced in Basel III. Those were liquidity coverage ratio and net stable fund ratio. So you can read about them. Okay, so very simple, explanatory. Tier, what is tier one capital? What is tier two capital? All that you have to read about them. So as a student of finance, you should know these terms. So I hope you get a picture about the short-term debt instruments. Short-term debt instruments. When we talk about short-term debt instruments, they basically, one minute. when we talk about short-term debt instruments, so they're basically in the form of money markets. So you can read about money markets. Then the bodies, the financial bodies which deals with money market, we call them as a primary dealer. Okay, then call money, notice money is very integral part of the borrowing and lending among the banking institutions, where the money is borrowed or lent for 1 day basis or 14-day basis. 1 day basis, if they do, then it is called as call money, and for the maximum period of 14 days when borrowing and lending is done, it is called as notice money. So you can understand the mainly the banks borrow and lend money in call money to maintain their CRR and SLR. CRR means cash reserve ratio. SLR means statutory liquidity ratio. Read about SLR, CRR. Certificate of deposit. You can I read about certificate of deposit. Mainly the banks used to issue certificate deposit to raise money for the working capital management. The minimum period is 15 days, maximum is 1 year. Okay, the amount, the money is being raised in the multiple of 1 lakh rupees, 1 lakh or one more than 1 lakh rupees. Then you have commercial paper, which normally the corporate issues. Okay, and the commercial paper issued in the multiple of 5 lakh or more than that. Minimum days is 7 days. Okay, so these are all treasury bills already. Then these all are the system CBLO, collateralized borrowing and lending obligation. So this is again a facility through which the borrowing and lending is being done by primary dealers. So you should have, these all are the information. So basically, whenever we talk about money market instruments, the individuals, the financial institutions which involve in money market instruments are called as primary dealer. Normally, money market instruments are basically zero coupon instruments. They're basically zero coupon instruments. They're basically zero coupon instruments. So they because you can understand the maximum maturity is either 10 days, 15 days, 1 month, 3 month, 7 month, 9 month. So in between giving coupon does not give any sense. So always understand they are always issued a discount. So they are always, whenever you talk about money market instrument, they are always issued a discount. Whenever we talk about money market instrument, they are always issued a discount. Always issued a discount means for them, the face value is always more than their price. For them, their face value is always more than the price. So the money what the issuer take from investor is suppose 97 rupees, and the money what the issuer give to the investor after 3 months is 100 rupees. So that way, the 3 rupees would be the advantage what the investor ultimately gain at the end of the day. So always understand whenever you talk about money market instrument, they are basically zero coupon instrument. For them, their face value is always more than their price. Okay, so then when we talk about long-term debt instruments, long-term debt instruments are basically coupon-based instruments. Whenever you talk about long-term debt instrument, they're basically coupon-based instruments. Whenever you talk about long-term instrument, they're basically coupon-based instrument where whenever we talk about coupon is always calculated on the face value. Okay, and I told you this, whenever we talk about long-term debt instrument, so they can be issued at par. At par means their price is equal to face value. They can be issued a discount. Discount means, what do we know discount? Discount means their face value is more than their price, or they can issue at premium where the price is more than their face value. So long-term debt instruments are issued for a long-term definite time period. After that, the company will buy back the instrument. So then the money what they'll pay back to the investor, that money is called as the face value. Whenever we talk about long-term debt instrument, they're basically non-amortizing debt instrument. They're basically non-amortizing debt instrument. So where the principal or the face value is paid on the maturity only. Okay, and during the life of the debt, instrument after every regular interval of time. The issuer give to the investor a fixed amount, which is called as interest or the coupon. Okay, so you know about them, you know the calculation also already, the calculation of pricing, the price of the bond, duration, YTM, all that I have explained to you. Okay, YTM, yield till maturity. Yield means the return. So yield can be of two type. It can be current yield also. It can be yield till maturity also. Current yield is nothing but it is the interest divided by the current price into 100. That is basically the current yield. Okay, so what is duration? Duration is basically the payback. Means as an investor, when you invest your money in the debt instrument, so after what time period you can expect that you'll get back your investment. I hope you know the term called payback. You understand the term called payback. So like the same way, so the logic of payback when you use in the debt instrument, then it is called as duration. The logic of IRR when we use in the debt instrument, then it is called as YTM. Fine. So I hope you got the logic. You understood the logic of duration. What is price? What is YTM? What is convexity? You got the logic of convexity. So actually, the when if you find the relation between Actually, if you find the relation between the price of the debt instrument with respect to the YTM, so as per the formula of the price of debt instrument with respect to the YTM, their relationship should be inverse relationship. So instead of being an inverse relationship, the actual relationship is a convex relationship. So already I have discussed the formula of duration, convexity, and all. Okay, so you know these terms. Then the next term which you should know is the yield curve. Then the next term which you should yield curve. So what is basically an yield curve? Yield curve is basically that the relationship between the yield till maturity of the bond to the time to maturity of the bond. This is very important term called yield curve. So yield curve is very important parameter. So when So here, whenever you talk about yield curve, so this when you talk about yield curve is very important term for your theory exam questions. You may get a question on what is yield curve. So you should know about yield curve. What are basically a yield curve? So yield curve is very important for your theory question. And yield curve is the line that plots the yield or the interest rate of the bond having the equal credit quality but different maturity dates. The slope of the yield curve gives the idea about the future interest rate changes and the economic activity. So there are mainly three types of yield curve: normal, inverted, and the flat. So yield curve is very important for the exam preparation. So yield curve basically plot the interest rate of the bond of the equal credit rating and different maturities. So by plotting the yield curve, you can expect the future interest rate in the market. You can see this yield curve. Okay, so basically, yield curve is used as a benchmark for the other debts in the market, such as mortgage rates or the bank lending rate, and it is used to predict the changes in the economic output and the growth. The most frequently reported yield curve compares the 3 month, 2 year, 5 year, 10 year, 30 year US Treasury debt yield curve rate are usually available on the website. So this you can understand the yield curve. So it is all about plotting the graph of the debt instruments having different maturities. So you take the bond, you take debt instruments having the same credit rating, and but their maturities are different, and you see their YTM, how much YTM they are giving to you. So on the if you try to plot that data in the form of graph paper, the line graph what you get that help us to predict the interest rate in the market. That is basically called as yield curve. So a normal yield curve is the one in which longer maturity bond have the higher yield compared to the short term bond due to the risk associated with them. Yield curve can be normal yield curve, it can be inverted yield curve, is the one in which the short term yield are higher than the long term yield. That is called inverted yield curve, which can be the sign of upcoming recession. So you can understand, I told you, like with yield curve, you can the market by looking at the yield curve. So normal yield curve, whenever we see the normal yield curve, so we can understand what we can understand the optimistic scenario in the market. While when we see an inverted yield curve, if you see an inverted yield curve, means there's a sign of recession. So there's a sign of recession, upcoming recession. Or when you see a flat or humped yield curve, then in that the short term and long term yields are very close to each other, which is a predictor of economic transition. So you can see that. So basically, when you talk about yield curve, so this is a normal yield curve. This is the normal yield curve. Logically, the debt instrument which are having higher maturity, which have longer maturity time period, they should give you more interest than the debt instrument which is having short term maturity. So this is a normal yield curve or upsloped yield curve, which indicate that the yield on the long term bonds may continue to rise because of the economic expansion. So whenever you see the normal yield curve, then you can predict and market where the market with time will grow only, that will expand only. So that is a normal yield curve. While if you see an inverted yield curve, means there's a possibility that the market will fall down in the future. So all the yield curve is very important parameter whenever we look into the debt instrument. So basically, when we see the debt instrument, whenever we look into the concept of yield curve, here there are basically three theories are there. So to understand the yield, the term structure of interest rate, so these are very important, very important for your exam. The you read about these three theory: pure expectation theory, liquidity preference theory, and preferred habitat theory. So they are very important theories when we study the term structure of interest rate, or when we are trying to study the shape of the yield curve. So pure expectation theories explain that the yield curve as the function of a series of expected forward rate. So when we talk about pure expectation theory, it explains that the yield curve, like I told you, the shape of the yield curve, it is either upward or either it's inward or either it is a flat. So when if you try to look into the yield curve and you understand what is happening in the yield curve, so there are three theories which explain what is happening with the yield curve. So basically, the pure expectation theory implies that the expected average annual return on the long-term bond is the geometric mean of the expected short-term rate. Okay, so for example, the 1 year spot rate can be thought as the product of 6 months spot and the 6 month rate for the 6 months from now. So basically, what the pure expectation theory says, that long term rates, what you see for the debt instrument, is basically derived from the geometric mean of the short term rates of the debt instrument. That is basically a pure expectation theory. So based upon the pure expectation hypothesis, we can calculate the series of short term rates which over any period will in aggregate will produce the rate expressed on the yield curve. Okay, then we have liquidity preference theory. So liquidity preference theory is a modification of pure expectation theory, incorporating the risk. So other things remain the same. Investor would prefer the short-term bonds to the long-term bond because the pricing of short-term bond is made easier by the lower price risk of these bonds and the shorter term to maturity. Therefore, the short-term instruments will enjoy a higher liquidity than the long-term instruments. So if an investor prefers short-term rates to the long-term rates, the interest rate at the lower end of the yield curve would be lower and the yield curve would slope upward. So liquidity preference hypothesis posed that the long-term rates are not only composed of the expected short-term rate, but also contains the liquidity premium. So the liquidity premium is the additional yield demanded by the investor to extend the maturity of the debt instrument over the longer period of time. Therefore, liquidity premium can be expected to increase with the time to maturity. So, liquidity preference theory, it is an extended version of the pure expectation theory. Pure expectation theory says that the long-term rates, what you get, it is derived from the geometric mean of what is happening with the short-term rates. But the liquidity preference theory says that there's an additional advantage what the investor get whenever they invest in the short-term instrument is the liquidity. So whenever you calculate the interest rate for the long-term debt instrument, you should also incorporate the importance of liquidity in them, and thereby you can understand the yield curve what will be likely in the future. And then the third theory is the preferred habitat hypothesis theory, which recognizes that the market is segmented and the expectation of investors are not uniform across the various tenure. So this preferred habitat hypothesis says that there is no relation between the short term and long term, while the pure expectation theory or preferred liquidity habit or pure expectation theory or liquidity preference theory, they were talking about the relation between the short-term rates and the long-term rates. But the preferred habitat theory posed that the distinct categories of investor exist, and that each of these categories prefer to invest in a certain segment of the yield curve. For example, the corporate with short-term surplus fund will prefer to deploy the same in short-term instruments and may be unwilling to take price risk associated with investing in the long-term instrument. On the other hand, pensions and the insurance company would prefer to invest in the long-term bonds to match their liability profile of their portfolios. Since the portfolios and the asset requirements of investor would vary, they would prefer some tenure over the other, and therefore they focus on the segment of yield curve. So the preferred habitat theory therefore posts that the demanding of demand and supply at various tenure of the yield curve, and an investor would prefer or prefer to receive or pay a premium or discount to shift away from the preferred habitat. So the shift, the shape of the yield curve would therefore is the function of demand and supply and does not have any formal relationship to the interest rate expectation. So the preferred habitat theory says that the yield curve what you get of the short term and long term maturities, it's all about the demand and supply. There exists no relation between the short term rates and the long term rates. So if there are more players like a pension fund companies or provident fund companies which prefer to invest in long term instrument, so automatically they will buy the debt instruments having maturity, very long maturity. So automatically there will be demand for the long term debt instrument. So if there's demand for long term debt instrument, automatically the price will increase and automatically the interest rate will fall down. While if there are more players who are more associated with mutual with money markets and other instruments, so they will invest in short-term instruments. So when they invest more in short-term instrument, so there will be more demand for the short-term instrument. So their interest rate will fall. So ultimately, when you see the interest rates, either short term or either the long term, it is basically it's all about the demand and supply mechanism, nothing else. This is what the preferred habitat theory says that. So I hope you got a logic about the understanding what I'm trying to make you develop by understanding these instruments. So anyone want to ask any question, feel free to ask me.